Good morning and welcome to this Wednesday, September 13th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we try to figure out what's happening today and what we can look at ahead. I can tell you one thing that's now in the books. That's the August CPI report, which came out just about 30 minutes ago. Numbers were okay. Really interesting. I want to show you the CNBC headline today. I always get a kick. Hold on a second. All right, so you should have the CNBC.com page on your site here, or on your page now. Take a look at the headline. So today they're going to talk about core inflation because excluding food and energy, it rose 0.3%, hotter than expected. Now, I can't tell you how many times the core inflation rate has either been as expected or lower, and the headline number has been hotter. And so the first thing they say is August inflation. They don't say core. They'll say August inflation or July inflation, not even excluding food and energy, but go with the headline number, saying that that's hotter than expected. And they ignore the core inflation number. Today, the headline number matched, but the core inflation number was up, and it was only up fractionally. It was not up a full 1%. And I know that because the annual CPI was as expected at 4.3%. So there was no and by the way, that annual core rate dropped from 4.7% to 4.3%. So we continue to head down toward this 2% target that the Fed wants to see. And yet the headline that you see only talks about the only thing in the report that could be construed negatively. The thing is with CNBC, I mean, they do educate, they provide information which educates, but their goal is clicks. And so the headline's not always going to be exactly, what's going on in the market. And anyway, I chuckle because, I look at the report and I'm thinking, okay, slightly higher on the monthly CPI, no doubt. But the annual number didn't change. That tells me that there's probably just a little bit of rounding between, the expectation could have been 0.24 and the actual might have been 0.26. I don't know. I will know later, but I don't know right now. It could have been very, very minor, but again, it's the headline number that comes out and says, hey, it's not good. We got core inflation jumping. Anyway, immediately the futures went down. Last time I looked, they came back. We can certainly take a look at those futures here in just a minute. I mean, I know 10 minutes. Let me give you right now, 10-minute delay, which is still 23 minutes after the report came out. The Dow futures have now turned green. Dow's up 14, S&P's up 1, NASDAQ's down 5. So really not a whole lot from anything because honestly, the report wasn't bad. I was a little worried. I thought the headline number might be a little hotter than expected. And I figured the core inflation, has been hovering right around 0.2, 0.3. So I think maybe the rounding got the best of us this time, went to 0.3. But anyhow, overall, I didn't think the report was that bad. But I was just wondering how CNBC would spin it. I chuckled when I saw the headline. I just wanted to share it. Anyway, taking a look at what happened yesterday, let's go ahead and move on. The Dow Jones Industrial Average was down 0.05% or 17 points. Not really much there. S&P 500 down 25, a little more than 0.5%, actually close to 0.6%. A little bit more damage there. Then you get into the NASDAQ down 1.11%. Say, okay, that was a pretty bad day on the NASDAQ as we finished at 15,289, which was back below the 50-day, but still above the 20-day. You can see the two moving averages right there converging on one another. And then you've got mid caps, which rose just under 1 point or fractionally, that's 0.04%. And the Russell 2000, which was down 0.1%. And then we had the transports, which are down about 0.5%. The interesting part here is that the Russell 2000, which is over the last couple of weeks really lagged the NASDAQ, but we see this back and forth. Yesterday, the small caps were better performers than the NASDAQ 100 by about 1 full percentage point. That's been going back and forth. The real thing that I'm looking at with the IWM is that the IWM relative to the QQQ, which tracks the NASDAQ 100, is about where it was at the beginning of June. It's almost even if you just pull up that IWM QQQ relationship. It's IWM colon QQQ. And you'll see it's been going down throughout the year, hit a low beginning of June, started to bounce, and we've gone back down and we've reached that low again, maybe even slightly beneath it. But on an intraday basis, the IWM is actually holding up pretty well and is well above that June low when we look at the IWM versus the QQQ. When we throw out gaps, you might say, well, we can't throw out gaps. Well, this is one of the things that I looked at in 2022 with the QQQ, saying that it was being accumulated, even though it kept going down. I think I'm seeing the same thing. I'm not sure. It's the first time I followed this. I'm not 100% sure that it's going to matter, but I think it matters. I think the fact that the IWM small caps have held their own and actually been rising versus the QQQ, while the overall ratio that includes gaps is back down at a recent low, a double bottom. I think it's significant. We're going to find out, because I think that's going to lead to outperformance in the IWM in the fourth quarter, but we'll see. Anyway, transport's continuing to struggle. I like the industrials. I wrote an EB Digest article about them a couple of days ago. I think that was the Monday article. And transport's obviously a big component. Transports have not been doing well, as you can see, over the last probably 6 weeks or so. But this is a group that went straight up for about 2 months. And so it's been pulling back. If you look at the Fibonacci, it's right about 50% of this pullback. So we're getting a kind of a normal, so far, Fibonacci retracement, but we don't have any technical signs that it's ready to turn back to the upside. And I know a couple of airlines today warned a little bit about their summer profits because of their increasing costs. Obviously, fuel's been going up. It's going to be really interesting to see how the transports react to the news today about those. I think it was American and Spirit. So it wasn't United, it wasn't Delta, but it's still American Airlines and Spirit. They cut their summer profit forecast on higher costs. It'd be interesting to see if all of the airlines go down based on that, or if we, maybe see a buy on the news. Could it be a sell on the rumor? Could be part of why transport's been going down, and then maybe a buy on the news as companies start to report that, hey, this is having an impact in our business. I don't know, but we'll follow it together. I'll continue to watch that. Looking at the sectors on Tuesday, the energy group was up 2.36%. That was your leader. Financials. We haven't talked about financials in a leadership role in quite a while, but they were actually second out of 11 sectors yesterday, rising about 2/3%. The laggard, technology, and that's why we saw some relative weakness in the NASDAQ yesterday. Technology dropped 1.81%. If you looked at the other groups, the other aggressive groups, communication services, consumer discretionary, also taking it on the chin a little bit yesterday. Integrated oil and gas was the leader within that energy space, rising 2.6%. You can see going up, closing at 799, which was its recent high. It certainly seems to be trending higher here. Banks, over the last 6-7 weeks, they've been moving lower. We did see a nice move yesterday, closing at 417.33. The 20-day, 417.57. So we are literally right up against the 20-day. We're also right up against the last reaction high on banks, up near this 420 level. So can we push through that? I think if we do, that's a good signal in the near term for the banks. If we don't, we roll over again. Well, we could be looking at further lows, maybe in the second half of September. Software, this is the area that was the weakest within technology. This is what dragged the technology group lower, and which also impacted the NASDAQ. Software fell 2.42%, falling back to 54.7960. And if you're looking at the moving averages, 50-day, 54.49. So that's about 35 points below, or roughly about 0.6%. And the 20-day is at 54.48. So we're moving back down in software, but we're still okay holding on to the moving averages. If we fall back below, it's simply telling us that we're in a trendless environment for software. If we hold and we turn back to the upside, maybe this is an uptrend. The long-term weekly chart we'll take a look at in just a little bit tells me we need to be a little bit careful with some of these aggressive sectors and aggressive industry groups. But again, I'll get to that in a bit. 10-year Treasury yield. Let's get an update here with the inflation, that headline number, core inflation up. Well, what's the 10-year Treasury yield doing? Initial reaction was it went higher up to 434, 4.34%, challenging this double top. But since it's come back down to about 4.29%, it's up about 3 basis points so far today. Let's see how this goes today. I'm really watching the bond market to see, because I do think if we break out in the 10-year Treasury yield, that could be a catalyst for the stocks not performing well in the second half of September. And that's kind of the typical history of what happens in September. First half of September tends to be okay, not great, but not horrible. You get into the second half of September, particularly when you get to about the 20th of the month. That's when things tend to accelerate to the downside. Right at the end of September, I think it's because companies at the end of quarters tend to come out with warnings. I think you see that more so in September because you're running out of months and quarters. You can't keep saying, well, we're not having a great quarter, but we think next quarter is going to be wonderful, and the balance of the year, oh my gosh, you're not even going to imagine how good that's going to be. Yeah, to me, that's not raising guidance. That's hoping for the best. And I prefer to see companies beat and raise, not miss and raise. You promised a certain thing in the last quarter and you couldn't deliver. And now you're telling us that we're going to raise guidance again. No, thank you. Wall Street usually ignores that kind of behavior. You tend to see much better response when you're beating and raising than if you're missing and raising. Anyhow, we do have that second half of September to look at. And if interest rates break out to the upside, that's probably not going to help anything as we try to navigate what I think is the bear's last gasp. And when I say that, I'm not saying that because I necessarily think the market's going to explode. I do think the market goes higher in the fourth quarter. I think the majority of gains in 2023 have been made, but I do still think we're going to have a nice fourth quarter. I think there's a chance we could get back up to the all-time highs. I'm going to give it better than the 50-50 chance. I'd say maybe 65-35 that we will go back over 4,800 in the fourth quarter and take out the all-time high. But I'm pretty comfortable, very confident, I guess, that if we don't take it out in the fourth quarter, we'll take it out in the first quarter of next year. And I think all that will come on the heels of all the interest rate hikes being done. Inflation, which has been going down now for quite a while, I think that continues. And we're going to talk about inflation in just a bit. I'll show you a chart on that. But let's keep rolling here. S&P 500. And oh, by the way, looking at that 10-year Treasury yield and looking ahead to economic reports tomorrow morning, we get not only the other inflation report, the PPI. I personally follow the CPI much closer than the PPI, but nonetheless, producer price index will be released on Thursday, along with the regular initial jobless claims and also retail sales. So we got like a three-headed, whatever you want to call it, tomorrow that the market's going to have to deal with. And so wanted to point that out before we moved on. S&P 500 still trading in this range, and if futures are any indication, probably just going to stay in this range even after the CPI report, not really showing which way it wants to go. 2 days ago, back on Monday, we were back above the moving averages. Yesterday, we dropped. We were back down below the moving averages. This is a trendless market environment. This is what happens when we're no longer trending. We are consolidating. The moving averages catch up with price, or you can say price pulls back below the moving averages, whatever you want to call it, but we're going sideways. The good news is after an uptrend, a sideways consolidation period usually usually, not a guarantee, usually resolves itself to the upside to follow that prior trend. So that's what I'm expecting. It's another reason technically. And that supports a lot of my below the surface signals that I've been seeing now for really throughout 2023. So those signals for me have been bearish, or excuse me, bullish. And so I see the market continuing to go higher. NASDAQ 100, very similar. We are still holding on to the moving averages, as I pointed out at the open. But other than that, pretty much the same chart. Topping in July, hitting that low in August, and now just kind of chopping back and forth. For the bulls, this would actually be really good if we could just continue to do this for the next 10 days, maybe 2 weeks. Let's get us through the end of September without another breakdown, and I'll feel very strongly about the market going into October. Small caps, maybe a little bit worse on a relative basis, although yesterday it was better. We did post a 6th straight day, though, of filled candles, which is a sign of distribution. Now, I'm not seeing a lot of massive filled candles to the downside. If you look back in early March, that was a lot worse. You can see that was pretty significant distribution. Excuse me. And that's when we had the banks struggling. Hold on one second. I've got a dry throat. All right, let's try this again. So we'll see if we can hold up at this support area around 180, 182.5 on the small caps. That's kind of what I'm watching. If we can get through the latter or into the latter part of September and still be holding on to this support area, I might consider looking at some leverage as we head into the fourth quarter. Although, even though early October tends to be pretty bullish for most areas of the market, small caps for some reason tend to struggle on a relative basis as we open up October. So I might decide to hold off on that leverage just a little bit longer, just to get us through maybe the first week of October. But certainly by the time, October is here and we start to get a really good flavor of what's happening in October. I think fourth quarter is going to be a strong one for small caps. But we'll see. I've been tooting that small cap horn for a while. Hasn't really panned out, but I stuck with the QQQ in 2022. I think that turned out to be the right decision. We'll see what happens with the IWM. Right now, I would say we're just simply consolidating and continue to watch it. Transports, we talked about that earlier. It's just been trending lower. This was an area right here that I thought maybe we would hold around that 15.5, 15.6 area. Tested it, went up to the moving averages, failed, rolled right back over again. You can see that daily PPO, not very strong. But it's really interesting when you're looking long-term at a chart, how sometimes the long-term can look a lot different than the short-term. I look at the daily chart and I think that doesn't look good. Kind of looks like an ABC correction, which wouldn't be too bad. But I just can't find anything that looks like really solid support until we get all the way down to 13.5. I mean, maybe this breakout right here, which is around 14.5, maybe that is the area where we end up gravitating toward. I don't know. But when you look at the longer term weekly chart on the 10-year Treasury yield, or excuse me, on the transportation index, you'll see an index that's been going up. PPO is still very positive. And right now, I mean, if we bounced off of this and kept moving higher, we would simply say this is nothing more than a 20-week test that we just went down and tested it. PPO was strong at the high, and then we turn right back up to the upside. I mean, we saw that in the past here when you break out. You move back, you go a little bit below the 20-week. I'm sure that didn't look very good on the daily chart, and then you come right back up again. So I'm not writing off transports, but I don't see anything on the daily chart that corroborates that we're going to bounce right here. So it's a little bit of a 50, well, I mean, I'm going to say maybe a 60-40 proposition. I kind of think from here we go higher. Maybe I'm going to give that about a 60%, the odds, and 40% lower. But if we get back up above that 20-week moving average, that would be a bullish development. So keep an eye on that. Now, I want to go over a few charts, and I can't recall if I've done that on the shows. I know I've talked about this with members in the daily market report. There are, or maybe it was the weekly, I think it was last week's weekly market report, the first one that I wrote. I talked about a couple of groups that on weekly chart, long-term weekly chart, were just very, very stretched and that I was worried about as we go forward. And those groups, I'll show you a couple of those plus a couple of others. But the first one I want to show you is semiconductors. Now, first of all, you look across and we actually broke out on the S&P 500 above the 2000 and 2000 highs on April 10th of 2013. So I consider that April 10th date to be the day that this secular bull market started. And you can see since that time, it's been mostly up, a little bit of sideways action here in 2015, 2016, a little bit of sideways movement here in 2018 through that cyclical bear market, the trade war, fourth quarter of 2018. We had the 2020 pandemic took us down into a quick cyclical bear market there. And then, of course, the cyclical bear market in 2022. But each one of these lows keeps going higher. And we just recently put in a higher high, which confirms that we remain in this uptrend. All of those things look great. So you might say, well, Tom, what looks bad? Well, I don't think it looks bad. I just think it looks overbought, like way overbought. And if you look at the weekly PPO, we went up and touched 10. Throughout the last 15 years, we've run on the semiconductors in 2008 from 500 to recently getting up near 10,500. That's quite a move to the upside. And during this entire period, we never saw the PPO, the weekly PPO, get to 10. The highest was about 8. That was back in 2021. And you can see after that, we went through probably about 6 months of sideways action. When we got up here to 6, of course, we had that quick cyclical bear market. When we get up here to 7 or whatever it was, back at the end of 2017, we pushed higher, but look at the PPO coming down. The rate to the upside changed. So the slope of the move to the upside started to decrease. And that's kind of what I'm looking for here in the semiconductors, because I've had folks write in and say, well, you know, I'm a little confused. You think the fourth quarter is going to be strong, but some of these key areas you're thinking, you know, could sell off. When I look at semiconductors, I'm not sure we're going to see a big sell-off. I think it's possible, but I think if we do see a big sell-off, I don't think we go to our all-time highs. I think that's part of the 35% odds that we don't see all-time highs. I think if the semiconductors stay where they are, or maybe just move up slightly higher, I think that could be part of an S&P 500 that sees an all-time high. So I'm concerned. What I'm saying right now is I think the risk of being leveraged or being heavily weighted towards semiconductors, I think that there's too much risk to do that right now. We've had a big run. I would be rotating into some other areas that tend to do well in secular bull markets, but that haven't done as well. And I'm talking about the health, or not the healthcare, but the transportation stocks that have come down. The industrials, which were up at 111, now they're back down to around 105, the XLI. These are areas of the market. Financials tend to love the fourth quarter, by the way. They could see a move back to the upside. I just see money rotating a little bit more than what we've seen. And you might say, well, if rates are topping, wouldn't that be a good thing for growth stocks? And yes, it is. And that's why I think growth stocks have been going up, because I think the market's been anticipating that. And I think we're going to pause next week again for the second time in the last 3 months, or last 3 meetings. And so I think the Fed is getting to the point where, as long as we don't see a major move back to the upside in inflation, and I'm not talking about what happened today, 0.2 to 0.3%, which in my opinion was rounding. I'm not talking about that. I'm talking about we start seeing 0.5, 0.6, 0.7. If we got a couple more of those readings, that could change a lot of things in the way the market is trading. I just don't see it happening. I mean, we haven't traded up in those levels for quite some time. If you look at the last few monthly readings, we've seen the CPI, core CPI, come down quite a bit. So I just see maybe a little bit more rotation like we did in the fourth quarter of last year. Actually, we saw some of the technology names getting hit a little bit, and we saw a lot of rotation into the industrials and financials, healthcare, and so forth. So that's kind of what I'm looking for as we head into the fourth quarter. Could semiconductors continue to fly? Yeah. I'm not going to put high odds on it, but yeah, they could continue to fly. I mean, I think if the economy does have a soft landing, many of these semiconductors, their earnings growth has been phenomenal. And if they can continue to show that, we might see prices just continue to move higher. Problem is, we're going to have a negative divergence on the weekly chart. So we're still going to have issues. I think what's going to happen with semiconductors, and we're already starting to see it, is I think some that have made huge moves to the upside, like NVIDIA, might simply calm down for a little bit. And companies that haven't really participated within the semi group maybe start to outshine. And I think we're seeing that with Intel. So we could see rotation within semiconductors. Intel might help to offset some of what we're seeing in like NVIDIA or AMD. So I don't know. That's kind of my thinking. Anyway, let's look at software. Software, look at the PPO, very similar. I'm not going to spend any more time on it, but our weekly PPO is as high as it's been, or almost as high as it's been at any point in the last 15 years. Home construction, I wrote about this in that weekly market report last week. Look again, the weekly PPO probably up between 8 and 9. And you look back, here was one time where we got to 10, and the pace of movement to the upside slowed. The PPO moved down, and we had a negative divergence, and then we had weakness. A year later, we had gone nowhere. So yeah, it did move up a little bit, but then it pulled back. We ended up going nowhere. I could see something similar here where we really struggle, but we push higher for maybe another 6 months, 3 to 6 months. And then the weight of those negative divergences, something comes out, maybe an NVIDIA shows slowing profit growth, and that could be a catalyst to bring the semiconductors back down to earth and get us a centerline reset. Those are some of the things I'd be looking for. Internet stocks, look at where internet stocks are, 8 on the PPO. Again, going back 15 years. When you get up here, it is a little bit more difficult. I think history tells us a little bit more difficult to continue moving up at that rate, that pace. And so that's what we have to kind of deal with. All right, market opens in 2 minutes. I want to do the our chart of the day. And what I wanted to do on the chart of the day today is, first of all, if you go to the chart of the day and you scroll down, you'll see there's a place where you can subscribe. It's a free subscription to our 3 times a week newsletter, Monday, Wednesday, Friday. Name and an email address. That's all it takes. You hit that subscribe button. If you don't like it, you hold on to it, check it out for a few months. If you don't like it, unsubscribe. It's fine. I mean, again, you won't hurt any of my feelings. I'm just throwing it out there, trying to provide some education, some trading opportunities if you so choose. Of course, that's completely up to you, but try to provide some good information, valuable information, educational information, and hope you like it. And I think you will if you haven't tried it. The other thing to mention, on Wednesdays, we have our live trading room at 10 o'clock today, 10 o'clock Eastern. We're talking in 30 minutes. We're going to open up our live trading room to members only. You can join a 30-day free trial, 30-day free trial. You have to give your credit card for this one, but we'll let you know at the end of your 30 days if you're coming up for renewal. We'll give you that warning. But 30-day free trial will get you the next 5 trading rooms on Wednesdays for free. Check us out. But here you can sign up. Again, it's a 30-day free trial, but you do have to give your credit card there. So what's the chart of the day for today? Well, I thought it would be a good day to look at inflation. This is a 75-year chart of the S&P 500. And by the way, for anybody who's always wants to be bearish the stock market, just take a look at this. Pick your spots to be bearish. Honestly, there's bad news out there all the time. Follow the signals that tell you that Wall Street's getting out. When that happens, when those big Wall Street firms are getting out, That's when you want to be out. Beginning of 2022, yes, that was the time to get out. We talked about that. Now is not the time to be getting out. My signals show me Wall Street is getting more and more in. They are all in. That's not usually when we see market sell-offs. But look at the long-term chart. For the most part, we go higher and higher. Change your mentality to think bullishly unless you have reason to think bearishly. The problem is when you have time, when it comes time to think bullishly, that's going to be like the end of 2021 when everybody's bullish. And that's when the carpet gets pulled out from under you. Anyhow, I just wanted to point that out because it's a long-term chart. This is where perspective really comes in handy. Look at the long-term chart, back up. Look at this. This is a nice little cup forming off of an extended uptrend. That's a bullish pattern to go with all the under the surface bullish signals. Anyway, here's a 12-month rate of change on the S&P 500. And down here at the bottom is a 12-month rate of change of the core inflation rate. Now, this does not take into account today's announcement, but look at what the core rate of inflation has been doing on an annual basis for the last close to a year now. I mean, this isn't my opinion. This is fact. Look at what the annual rate of inflation is doing. It is going straight down. So the Fed, hey, they need to be worried about price stability at all times. So I understand why they're saying, hey, we want to squash it out now. I get that. It's probably the most important part of their job is to keep inflation in check. Certainly one of them. Obviously, we want employment to be high as well. But keep inflation in check. Inflation is heading in the direction that the Fed said they wanted. Now, they've changed their tune multiple times over the last 2 or 3 years. But right now, what they're saying is they want to see inflation continue to move down toward their 2% target. Well, we've gone from 6.5 now. Today, we were at 4.7. Now we're at 4.3. We've now gone halfway. We're halfway home from 6.5 to 2%. Halfway home is 4.25. We're right there. So this is why growth stocks have been doing well. The stock market is looking at what's happening with inflation and ignoring what the Fed is saying. They're building in, they're buying on the rumor. And that's why I think rates could come down and value could lead, because I think it could be for growth stocks buying on rumor and it could be a sell on news. I don't know. Anyway, what I've done here, these green dotted lines, I have marked at inflation peaks. Every inflation peak, the major ones, since going back into the early 1970s. And what you see generally, 1 year later, every single time the stock market's been higher. Now, there have been a couple of exceptions where, like here, 2006, this was part of the secular bear market, but probably about a year after we went higher with this higher spike in inflation, we went back down. But when we went down, it wasn't because of inflation. Inflation kept going down. That wasn't a problem. But if you look every single time after the green dotted line, the stock market goes higher. Here we went early 80s, we pulled back for a little period of time. And we went sideways here. But generally speaking, you go up when inflation peaks and starts to roll over. The one in 1980, early 80, this one, the major peak, that started a 20-year secular bull market from early 1980s all the way through the end of the 1990s. So we're already in the middle of a secular bull market. I'm not saying this is going to trigger another 20 years, but I do think we could easily have another 8 to 10 years in this secular bull market. Possibly a little bit more, but I'm thinking 8 to 10 years, and it'll probably run its course. But you can see the rate of change. Look at the rate of change of the S&P 500. Since inflation's been going down, the rate of change on the S&P has been going up. So all the fear that was built in about inflation, once inflation topped and started rolling over, it was behind us. The cyclical bear market is over. Over. It was over in October. I called the end of it in June. I was a little premature, but I think if the Fed didn't keep changing its tune at Jackson Hole speech in 2022, I don't think we would have gone back down to a new low. I mean, there's no way to prove it, but I think that was a Fed-induced 2-month move lower, and then the market came roaring right back. Anyway, I just don't see the market going lower. Another inflation report that comes out that takes the annual return or the annual rate of inflation down from 4.7 to 4.3. Anyway, the market is now open for about 5 minutes. Let me just go in here and let's get a quick look at what's happening. S&P is actually up about 10 points, close to a little more than 0.2%. Let's take a look at the dashboard here. It looks like small and mid caps are flat. Now we're seeing the other groups up about 0.25%. So we've been flip-flopping in this strength. The VIX, though, down almost 3%, back down below 14, with another inflation report in our rearview mirror. I mean, that's another thing. Bear markets don't thrive in a VIX environment where we see the VIX in the low to mid teens or even into the upper teens. 13 to 17, I'm not worried about. 17 to 20, you start, maybe the caution flag goes up. You break above 20, then we got some issues to talk about. Volatility is not giving us any signs of weakness ahead, and I find that to be very bullish. So I just don't see a whole lot of bearishness in the market, and I'm going to trade what I see. And so I'm going to stick with the long side, knowing, by the way, that the second half of September tends to be weak. I'm not in leverage. I don't know what the next 2 weeks holds in store for us. We could see another drop. If we do, I think it'll be an opportunity, a big opportunity for anybody who's waiting to get into this market. All right, that's it for me. Again, sign up for the EB Digest. You'll get that 3 times a week, Monday, Wednesday, Friday. It's free. Love to have you. And then today, in about 25 minutes, live trading room. So if you want to check out the live trading room and check out our entire service, 30-day free trial gets you in not only to today's trading room, but the next 5 Wednesday trading rooms. Love to see you there. Have a great day, everybody. Happy trading.